We're about to walk through a hypothetical example where a real estate investor used a cost segregation study to create over $100,000 in deductions in a single year. Now, as a disclaimer, I've worked with clients who have implemented similar tax strategies and had similar results, but I can't guarantee this will happen for everyone. Every situation is different, and so results are going to be different as well. And they just depend on your specific financial circumstances. But here's what I can tell you. Cost segregation studies are one of the most powerful and most overlooked tax strategies available to all real estate investors. And most CPAs never bring them up. So first, I'm going to explain what a cost segregation study is, then how it works, and walk you through a hypothetical scenario of how someone used a luxury short-term rental to accelerate depreciation and reduce their tax bills significantly in that first year. If you're a high-income earner who's also investing in real estate and you're looking for legitimate tax strategies, this might be the most valuable video you watch all year. And just one more quick disclaimer, this is educational content and should not be considered tax advice to you and your individual situation. Before using any strategy like this, you should work with a qualified tax professional who understands your complete financial situation. Okay, now let's dive in. So first, what is a cost segregation study? This is an IRS-approved study, usually done by an engineer, to reclassify components of your building that you acquired into its various other smaller component parts. Typically, when you acquire a rental property, everything is going to be depreciated over 27 and a half years if you acquired a residential property, or 39 years if you acquired a commercial or non-residential property. So what the study is doing is taking all the component parts of the building and splitting it out into things like cabinets, countertops, appliances, light fixtures, roads, sidewalks, decks, things like that. And that's going to give us now things into the 5-year property, which is going to be personal property. We're going to get things that are 7-year property. We're also going to get things that are 15-year property, which is typically land improvements. So now, instead of just 27 and a half or 39-year property, now we also have 5, 7, and 15-year property. And the reason this is so significant is because anything that has a useful life, according to the IRS, of less than 20 years is eligible for bonus depreciation or accelerated depreciation. And if we do this right, using some sort of non-passive tax strategy, which I'll talk about more in other videos, this is going to allow you to have a huge loss to offset other non-passive income, such as your W-2 or business profits. A lot of CPAs are not going to bring this up because they're generalists. They don't have a specialty in these unique tax strategies like real estate for real estate investors. And so they're just not familiar with them. And because they're not comfortable with them themselves, they're not going to recommend it to you. And a lot of our profession as CPAs and tax professionals just simply don't have the time. So that hurts your tax savings and the benefits financially that you could have from using a cost segregation study. Okay, so let's transition to how this might work with a hypothetical scenario. Let's say that you're a high-income earner and you're making almost $1 million a year from your job that you have as a W-2 employee. You purchase a short-term luxury rental in a great location for $1.4 million. Now, one of the first things you do when you acquire a rental property is you determine the split between the building and the land. Now, let's say that you have a split that's pretty typical average as a rule of thumb, and it's going to be 80% of your purchase is going to be to the building, and the other 20% is going to be to the land. Now, what that comes to is $1.12 million of building purchase basis and the other $280,000 of land, coming up to our total $1.4 million. Now, if we have a short-term rental, that's going to mean we depreciate this property over 39 years. And if we did no cost segregation study, that would mean you have $28,700 on an annual depreciation basis for the building. Now, if that's all you did and you were able to use those losses from the depreciation to offset your other non-passive income, that could result in over $10,000 in tax savings if you're at the 37% tax bracket, which we have in our example. And if you were working with a generalist, this is all they would do for you. And you would be very upset if I came to you in the next year and I told you all about cost segregation studies and how you could have got more tax savings, which I'm going to walk you through next. Okay, so now let's say instead you go get a cost segregation study performed on your short-term rental. Now, before I get into the tax savings benefits, let me walk you through a couple things. A cost segregation study has 2 main types of studies that are out there. Number 1, you have more of a do-it-yourself software option. Those are typically going to cost between $750 to $1,500. And option 2 is you have these engineered studies, which are going to be done by a professional engineer, And those are typically, I have found, going to be somewhere around $3,500 to $5,000, depending on the property itself. Now, a software study, you are going to do that yourself. And so that could take you maybe an hour per property. It's going to be very fast. The engineered studies, on the other hand, depending on what season we're in, they might take a month or two in order to complete the study for your property. What's really going on is they are taking a look at your individual property and figuring out, taking pictures, doing a site visit, or using things like Google Earth as an example. They are going to determine what component parts in your building should be depreciated over what useful life according to the IRS. The cost segregation studies are typically going to result in about 20 to 30% of the building getting reclassified into these shorter asset lives, like 5 or 15-year property. Now, if we assume that about 25% of your building basis is going to get depreciated into this more accelerated amount, that means of the $1.12 million, $280,000 is going to be accelerated into the current year. And I'm saying the current year because we're in a year that we now have 100% bonus depreciation thanks to the new tax bill that came out in 2025. And if you do this appropriately, you can take all of that in the first year if it's beneficial to you. So instead of our client making $1 million a year, now if we accelerate and say everything else is even, that the net operating income was flat, even if we just have the accelerated depreciation that's going in, now instead of paying tax at $1 million of income, now we're only paying tax at $720,000 of income. That is potentially over $100,000 in tax savings from one luxury short-term rental this year. It's not going to completely offset his entire taxable income. I get that. But with the income that is there, and being in the 37% tax bracket, this has significant impacts as long as we can offset the non-passive income via real estate professional status or the short-term rental tax strategy. Again, I'll have more videos on that in the future. And again, this is just an example. Specific results will depend on your situation and the actual results of the cost segregation study themselves. Now, before I continue with cost segregation studies and when they might make sense and when they might not, I just want to mention one thing. What I just walked you through is exactly the type of proactive tax strategy that I explore with my clients at Carriere Tax Consulting. We work with high-income earners, typically people making over $300,000 a year, who are interested in using real estate tax strategies to offset some of their tax burden for a holistic tax plan. This is not for everyone, and we can't take on every single client because this is personalized one-on-one tax strategy, and we have only so much time in a day. But if you're someone who wants to explore this and see if some of these strategies make sense for your tax situation, click the link in the description to book a call with me. We'll discuss your specific circumstances and see if there are opportunities to help you implement some of these tax strategies. It could help you keep more of what you've earned. No guarantees, just an honest conversation about whether I can help you. All right, now let's get back to the content. Okay, when might cost segregation studies make sense? And when might they not make sense? First and foremost, this is not a one-size-fits-all. This is very specialized to your situation and the properties and your plans moving forward. The minimum purchase price I would consider getting a cost segregation study done is about $150,000. If you're getting a purchase price around that amount or anything up to $500,000 or $750,000, I would strongly consider doing a software study. But if you're acquiring a property at $750,000 or more, and especially if you're in a high income tax bracket, I would strongly consider doing an engineered based study. Is this good for people who are in a lower income tax bracket? Not necessarily. The threshold that I have for most of my clients is about 24% tax bracket federally. So obviously that's going to fluctuate depending on if you're single or if you're married and what kind of income that you have that year. But more specifically, if you're in a tax bracket like the 37 or the 35% tax bracket, I would strongly consider you moving towards an engineered based study. In contrast, then, the only situations I really would not recommend a cost segregation study based on purchase price and tax brackets is anything below $150,000 purchase, and if your tax bracket is at the 22% or lower. Or if you are planning to sell that rental property that you're considering doing a cost segregation study on over the next 1 to 2 years. Or if those losses are going to be passive and going to have to be suspended. You have to remember that you are getting a significant benefit in the form of accelerated depreciation now, but keep in mind when you sell, you do have depreciation recapture. I want to make sure that that's clear. So if you're planning to sell, like I said, in the next 1 to 2 years, it's not recommended that you do a cost segregation study only in very unique circumstances. And even if you do sell the property in 3 years, 4 years, 5 years, 20 years, and you have a significant amount of depreciation recapture, there are solutions such as a 1031 exchange. That's usually the best option. If you're considering working with me, I would recommend that you're in the 24% tax bracket or higher, that you're planning to buy more real estate and have this offset your W-2 or business profits as a non-passive loss, and your purchase price is somewhere north of $150,000. The higher in the tax brackets and the higher in the purchase price that you're looking at, the more of an impact I can have with you. So why isn't this strategy talked about more? Most CPAs are just focused on compliance and getting your tax documents into your tax return for you to be compliant with the IRS. And that's it. They're not proactive and they're not considering how to be strategic for you. You're really not paying them to do that. You're paying them to take tax documents and spit out a tax return. That's it. And if you're tired of that being the case, and you're frustrated with no communication, no proactive tax strategy, really poor communication, and being in the same results that you're getting year after year after year, it's time to make a change. I've seen clients come to me after holding properties for years and still a cost segregation study makes sense. And they are very frustrated when I tell them the amount of tax savings that they've been leaving on the table sitting in the IRS's bank account. Typically, they're very frustrated. Also, if you talk to a CPA, a tax professional, and they tell you that cost segregation studies are illegal, it's time to leave. The value of working with a real estate specialized proactive tax strategist is not only getting into things like cost segregation studies and making sure it fits your situation or not, it's way beyond that. Okay, I know I just covered a lot of ground here. Cost segregation studies can be one of the most powerful tools for real estate investors. And when it's done correctly, in the right circumstances at the right time, it can have massive tax impacts. But this is just one tax strategy. There's also real estate professional status, there's short-term rental tax strategy, there's entity structuring, there's exit strategies, there's shifting income to your kids and oil and gas investing, and so much more that goes into a holistic tax plan. If you're a high-income earner, you need to start considering some tax planning. And if you're trying to navigate this all on your own without any specialized guidance, you have a huge gap in your understanding and you're likely missing out on significant opportunities or making mistakes. I've seen all of it happen. That's where specialized help can actually come in and can make a difference. And exactly why we focus on helping high-income earners explore how real estate might fit into their overall tax strategy. We've worked with clients who've implemented these strategies and so much more, and they typically result in about $25,000 in tax savings per year. In some cases, much more. Again, I can't guarantee specific results for your situation because it completely depends on the real estate, your goals, the real estate that you acquire, and so forth. But what I can offer is a proactive tax approach where we look at every legal tax strategy out there and you work directly with me rather than being handed off to someone else. So if you're making over $300,000 a year and you want to have a conversation about whether tax strategies like this make sense in your situation, click the link in the description and book a call with me. We'll discuss your circumstances with no pressure and no guarantees. Just an honest conversation about your situation and how I might be able to help you. Thanks for watching. If you found this educational, subscribe to the channel for more real estate tax strategies like this, and I'll see you on the next one.